Hi, gang. This is Jay Breitlow with Grand Welcome of Greater Orlando, and joining me today is Stephanie with Inspired Waves Home Mortgage. I got that right.
Home loans.
Home home loans, blast. And so we've been talking quite a bit, and we work really well together with people who are looking to purchase STRs, short-term rentals, specifically in the Orlando region. Well, you and I generally only talk about the Orlando region because that's where I work out of with the property management business. And I'm getting a lot of people who are looking for homes, um, and they want to know a couple things. Like the most obvious thing they want to know is, can I afford it? And that's where I come in. If you're looking for a property and you want to know basically, does the price point of this house and the potential for income, do they line up? Can I build a pro forma that works? That's where I jump in. But then you got to look at how much is my mortgage. That's where she comes in. And so one thing is, can I get a mortgage? What do I base the mortgage off of? What type of credit score do I have? I mean, there's a whole bunch of questions here. So I'll let you take over. What are the most common questions that people have when they're looking at an STR, when they want to get into the industry? What are they looking for, first of all?
I think probably a minimum down payment that comes into play usually first. And there's, a lot of different loan programs that play into what you can put down for down payment. There's conventional agency loans, and then there's non-QM, non-qualified mortgages, which are, I would consider outside of the box loans. And there's a lot more that you can do with those. I mean, they have no ratio, they have less money down, lower credit scores.
Wait, hold on. So not okay. So go back. Non-Q, non-qualifying loan. So explain that a little bit.
So a non-qualified mortgage is a non-agency, so it's not sold to Fannie or Freddie. So back in the day, we called that subprime lending. So it's kind of like the next tier of subprime lending, but there's a lot of different arrays of programs. For example, you could use bank statements instead of tax returns. That is very advantageous to some self-employed borrowers to be able to show their income with bank statements and not tax returns. So with the non-qualified mortgages, we can do higher loan to values, less money down. So for example, I can do what they call a no ratio. So no income, no employment is verified, and that consumer can put down a minimum of 15% with no mortgage insurance. So granted, the rates are a little bit higher for that risk, but it gets someone into a situation like this for a short-term rental to get into the property before values and prices go up more, and they start a revenue source. And
So
that's where you can show those numbers.
and I think if you didn't miss that point, the point was the I'm going to paraphrase this. You're going to pay more for that in terms of percentage, right? You should, but the percentage that you'll pay for it more in terms of mortgage is far less than the market is growing, certainly right now in 2022.
Absolutely. I mean, just for a comparison, again, so much goes into rates and pricing, credit score, loan to value. And there's so many different aspects, right? But to give kind of a range, you're probably looking at the high fours. Now, APR depends on loan amount, actual loan amount, but to kind of give it a guesstimation, you're looking at high fours versus you'd be in the, high threes on a conventional investment loan. So we look at this property as an investment, even though it's short-term rental, which another thing on conventional loans, the guidelines are going to want to see a lease to counteract the payment. If not, you're going to have to hit that entire new investment property payment to the consumer. Well, when you look at something like a non-qualified mortgage, no ratio, debt to income ratios don't come into play because we list no income, no employment on the loan application. So it opens up more availability for borrowers to qualify.
So how does the bank say, okay, we know you're going to cover the mortgage?
Well, they're assuming the risk of that no ratio in the rate, basically, is what they're doing. That's why the rate's higher, because it's a higher risk for them. So it's a purchase contract, source of down payment, title, appraisal, evidence of insurance, and you're pretty much good to go. So we literally do not verify any employment or income on that
So,
program.
so I mean, it sounds too good to be true.
I'm doing many right now, and
Um,
they're closing.
is this? I've heard of portfolio loans also, right? Which is when again, but course correct me because this is not my area of expertise. Uh, Portfolio loans when the bank comes in and says, all right, if something were to happen and they couldn't make that loan payment, we're okay adding this property to our portfolio. Is that this is similar to that? Is this I know with portfolio loans you generally still have to go through a huge underwriting process, but this sounds different than that.
Right. So it is, I mean, it's close to a portfolio loan. The biggest difference is it's not a bank per se, it's a large lender, mortgage lender. So they do have a servicer and they're going to sell those loans to their servicer. So it's not kept in their portfolio. So there's the difference. On a bank or credit union, yes, something like this they would hold in their portfolio, but this lender is actually selling that loan to their lender. So in essence, it's not kept in their portfolio.
And then the other pessimist in me says, all right, well, what's the deal with fees? Like, what does this look? Because you're one of the fees to skip the documentation is a higher interest rate. We get that. Okay. Are there other fees? And this isn't like, please tell me more. I generally don't know the answer. Like, are there more fees in that?
Yeah, so in the mortgage world, there is, and this gets a little bit complicated. I'll try to break it down. There's lender paid and there's borrower paid. So the lender can pay the mortgage broker, or the borrower can pay. Okay. Obviously, if the lender's paying that broker, they're going to assume that in the rate. So yes, you can have loans that the lender pays the mortgage broker and there's no origination fee. So there's no 1% of the loan amount. There's going to be an underwriting fee. There's going to be appraisal fee, credit fee, and then title fees. But honestly, the lender fees are not heavy on this loan.
Okay. And next question is, okay, I'm looking at a 50,000, 500,000, yeah, $50,000 house right next door.
That'd be great, Jay. Sign us all up.
So $500,000 house, which is common. I have a couple clients who are going in today looking at a $500,000 7-bedroom house. Yes, they exist out here, and yes, they cash flow. What are you looking at for 10, 5, 15, 20, 25% down? Sorry for the wind. I don't know if you can hear that wind.
A little bit. In terms of closing costs, what are we looking at?
What are they putting down? Are they putting 15% down, 20, 25?
They could put a minimum on this non-qualified mortgage. They can put a minimum of 15% down. If they can qualify, they want to go conventional. I mean, there's conventional loans obviously available for something like this. The biggest thing is that when we start to look at this short-term rental, it's a whole nother caveat to investment, right? Because we cannot use the rents from short-term rental income. We have to have a true long-term lease if we go conventional. So conventional, if you're non-jumbo, you can also do 15% down. But if you don't have a long-term lease, then you're going to have to qualify with that additional payment. So that's why this non-qualified mortgage product is really, a lot of consumers are loving it because they're like, okay, I don't have to basically qualify. If I've got the 15% down, I don't have to show income.
So the audio came through fine. The video wasn't great, but I heard all that. So then this leads me to another thing. Can I put the LLC, my S Corp? Because the way I like to invest is have my LLC. I have like my S Corp 2553 form for tax purposes. So can I invest as my LLC? Can that be the lien holder? I'm guessing not, but.
Actually, on the non-qualified mortgage programs, it can. So there's another difference as well, because when you're conventional, yes, you are correct. We lend to the individual. They hold title as the individual.
Well, that seems like another bonus.
Yeah, and another thing too to keep in mind is that, yes, the rate is going to be a little bit higher on the non-qualified mortgage. I'm not a tax accountant. I will not advise anything in terms of tax purposes, but I would always say for that consumer to talk to their tax preparer, their accountant, and say, hey, is it going to help me out to have more interest to write off at the end of the year? Again, I'm just giving food for thought. And then another thing to remember is that there's no mortgage insurance. So on the conventional side, normally, if you're going to exceed, 20%, loan to value, you're going to have mortgage insurance. Well, there's a cost to that. So sometimes net, and I can always run numbers. Sometimes the net is fairly close to no mortgage insurance, higher rate.
How does that work with deductions on taxes? The same thing, like the interest payment would go off as a. I mean, I assume you would just, since you're running that through an LLC, that would just go in the loss category, correct? Like the deduction would be the same. Is there a different formula for deduction?
Yeah, I mean, I can't speak to, I never want to cross the line on my expertise, but if you're paying the higher rate, obviously you're going to have more interest, that could potentially be deducted.
Other things I'm thinking of, if I don't have a great credit score, what are you looking at in terms of credit scores?
So we can, depending on the loan to value, I mean, we can get into the 600s, into the low 600s. So that's another piece as well. That obviously helps on the non-qualified mortgage side. You don't have to have the 720 credit score. And credit scores, there's a lot of factors in credit scores. It's not always meaning that someone's got derogatory credit. It could be that they've got numerous properties, or they carry, debt due to a business, or they have inquiries on their credit due to their business. They've got different consumer loans, installment loans. So it's not always that they're a derogatory credit because of lower scores.
So then this leads me to, again, I've worked with portfolio loans. Generally, you can only have like 3 with a company. Are you limited by what you can do here, Stephanie? You've got 1, you can't do 2. You've got 2, you can't do 3. What's the? You
can do more on the, I believe, and don't quote me on this. I can get this. We can circle back on this video and follow up. But I believe on the non-qualified mortgage, you can do up to 20.
Well, that's more than the 2 or 3.
Correct. Yeah.
I was expecting. Yeah. And so if you're cash flowing and if you're in the bigger pockets and you're borrowing, you could take. So can you refinance, pull cash out? What are their options for that also? Because again,
yeah, absolutely. I mean, it's not just purchase on non-qualified mortgage. So yeah, you can do cash out refinances. Again, there's also the bank statement loans. So bank statement loans, you could use that on a purchase. You can use that on a refi. Rates are going to be better on that because, again, less risk, right? They're at least they're using the deposits. So they take all the deposits on the bank statement and they're doing a 12-month average, and that's the income. So at least they're looking at some income source. So when you get into the non-qualified mortgage programs, there's so many options.
You're making me want to very quickly pass less projections on the clients and want to invest more myself.
Absolutely. And like we talked the other day, you've got my wheels churning. Now I'm like, maybe this is something I need to get into as well, right? Investing. So it's
a couple things. Generally speaking, my rule of thumb is I want to be in a scenario where I'm investing in single family homes. And if you're a client coming to me and you're saying, what do? I want to put you in a single family home. It's going to appreciate better. You've got less HOA restrictions, generally speaking. You have more property manager options. But just for giggles, outside of single family homes, condos, condotels, are these options for you also?
Yes. So that's another thing with non-qualified mortgages is you can do condotels, which you cannot do on the conventional side. We can do duplexes, fourplexes.
Not a fan of condotels at all. It doesn't make much fiscal sense, but you certainly can, and people buy them. But really, when we start to turn the screws, it just doesn't make a whole lot of sense for the condotels. But you can.
Yeah. And I think really it depends on different markets, right? So, mountain communities in Colorado, in Montana, you see more of the condotels. Florida, you probably don't see as many of those. I don't know. I mean, do you?
Yeah. Well, in Orlando, just it's a thing. It's a convenience thing. You get rides to and from the airport, but I mean, it's just inexpensive to get rental cars. Anyway.
Well, it can be done. Non-Q.
Sorry, video cut out. It can be done with the non-qualifying loans. I think that's what you.
Absolutely. Yep. We can do foreign nationals. That's another thing too. ITIN cards. So we have so many different arrays of opportunity with that product, with the non-QMs. Not to take away from the agency loans. I'm just giving a overview of more things that can be done right now.
At this point, if you've watched the video this long, I hope you click in the comments / the description. Stephanie's info is here. She's great. Just pick up the phone, call her, email, text her, and she'll let you know what your options are. And maybe that leads to another question, like the turnaround timing. For the time somebody contacts you, I want to move on this property, how quickly are you getting out like a pre-approval letter that goes out to the seller to closing? What's the time frame? 30 days? What does that look like, Stephanie?
Yeah, I mean, right now I've got one that's closing that we were in about a 40-day escrow and they wanted to move it up. And I was like, sure. And I think we're doing it start to finish with an appraisal on about 27. And that's also throwing in Monday as a holiday. So 30 days or less, absolutely.
Okay, cool.
And I can turn, pre-quals, I'll turn in 24 hours or less. I mean, I can do it within a couple hours, depending on when I receive it. I've got a website that's got a link, so it's very quick and easy. So I turn these quickly because right now the markets, they need it. They need it to move quickly.
Right. Yep. Absolutely. I don't have any further questions. Do you have any assertions?
No, I'm glad that we got to do this today.
Just going through my head here, my list of things that I want to consider. If you are, another possibility, somebody's getting into an STR, the home is empty, doesn't have furniture. Do you have any flexibility to build that loan out also so they can put furniture in it as well? Or would that be, usually it's something totally separate from the mortgage. I get that. Is that?
Yeah, we can't do what they would call a cash out purchase. So we can't build any cash into the purchase transaction. Now, granted, once they own it, yeah, we can cash out. I'm seeing too, a lot of these appraisals are coming back. There's instant equity.
What do you do if the appraisal comes up short? Is that just typical where you'd write the difference between the appraisal and the, you are still hard fast with the appraisal, correct?
Correct.
I assume that because you're skipping.
Yes. So whether it's conventional or non-QM, they're going to use the lesser of the two, purchase price, appraised value. So then we would, if there is a difference, we'd call that appraisal gap. And they would have to bring that additional gap between the appraised value and the purchase price, additional cash to closing.
Now, what can be done here is generally when you put an offer on a house, it comes with the furnishings. So that's kind of like, generally speaking, in Orlando, it's like an unwritten rule that it comes with. And sometimes there'll be some dialogue with the seller, is furniture included? And, well, no, but for $5,000 more, whatever. Those, where it's not reflected as the furniture is included, it's all part of the package deal, right?
Part of the purchase price. Yeah, that makes sense.
I don't have anything further, but questions on property management, questions on the buying process, questions on mortgages. We're your team. We're here to help. We work really well together. At least we do right now. At least I work well.
We always work well together.
You might not want to work with me. Questions, drop us a comment here. Hope this was helpful, gang.
Have a great